Hello, everybody. So, some of my reviewers have asked that I cover the Magnificent Seven with my hypergrowth spreadsheet that has become kind of a hallmark of the channel that I keep using everywhere. And so, of course, Magnificent Seven, you all know my favorite in there. It is Tesla. I've covered Tesla a lot on this channel, at least in all of my spreadsheet videos. And I believe it's the most compelling buy out of all of the three, even though admittedly, Tesla does not score very well on my two favorite metrics relative to other Max 7 stocks. It doesn't score very well on enterprise value over gross profit, over revenue growth. As a reminder, this is my spin on Peter Lynch's PEG ratio, except I use gross profit and revenue growth instead, because I usually focus on hypergrowth companies on this channel. Noteworthy to say that Tesla's PEG ratio is actually under 1 now, so that's inexpensive from a PEG ratio standpoint. But I also use the rule of 40. Rule of 40 means adding the economic value created by the firm to the expected growth for the firm, and ideally you'd want this to be more than 40, and in the case of Tesla, it doesn't meet that. So admittedly, when you just look at the numbers, Tesla is not the most compelling. The most compelling is Nvidia when you look at the number. And I know it sounds crazy because it's become part of popular culture to say that Nvidia is so overvalued. And if you look at, say, 35p, I mean EV over revenue, but equivalent of a PE, right? When you look at that PE, it's a nosebleed PE. It's about the same PE as CrowdStrike. Well, I own CrowdStrike. I don't have any problem with that. And, it doesn't grow as fast as NVIDIA. So I actually, when I look at this, I ask myself, why don't I own NVIDIA? Well, guess what? I used to own NVIDIA, but I sold it for a nice profit. Yet another mistake, right? It's like you don't want to sell a stock for a profit too early, and that's what I did with Nvidia. And now I feel bad getting back in because I sold it from melting US dollar fiat type stuff, and I should have kept Nvidia. It's okay, you learn from your mistakes, right? But Nvidia, I mean, the analysts are predicting outstanding growth at 69%. They keep beating expectation. Gross margin is outstanding, 73%. At this point, that's mostly net margin too, because they have a 57% EBITDA margin. So it's just a mind-boggling amount for NVIDIA. When you add revenue growth to EBITDA margin, you get 126%, which is a score that I've only seen for, say, companies like Celsius and Transmedics, essentially. And that's when these two, when you're optimistic about their revenue growth, that you get to that number. So NVIDIA is absolutely outstanding. It's noteworthy to say that NVIDIA is a $2 trillion company. For the longest time, we had Microsoft and Apple be $3 trillion companies, but Apple has taken a breather, and as you will see in a second, Apple is not very kind to my spreadsheet. My spreadsheet is not very kind to Apple, because Apple has had almost no growth. So anyways, NVIDIA is expensive if you look at the EV over revenue metric, but it's very cheap if you look at the 0.7 here on my enterprise value over gross profit over revenue growth. I think NVIDIA is the most objectively compelling stock out there in my view is in NVIDIA. I wish I still owned it. I wish I hadn't made that mistake to sell NVIDIA. Now let's look at the one stock, and I'm going to move this to enterprise value over revenue. Let's look at the one stock that is the most undervalued in there based on revenue, which is Amazon. So Amazon is only trading at 3 times sales. Take a pause, take a moment to look at how insane this revenue number is. It's $574 billion, of course, growing at 12%. Keep in mind, that's going to compound. Give it 3 years, and Amazon will have close to $1 trillion or about $1 trillion in revenue if you give it 3 years. And I just want to take another pause to look at how important these companies are. And I own the NASDAQ in a few retirement accounts, and when I see these numbers, it gives me absolute confidence. The sum of these 7 stocks is $2.6 trillion in revenue. Now keep in mind that's their top line money coming in. That's their top line transaction. That's about 15% of the US economy. 15% of the US GDP goes through the top line of these companies. And many of them are transaction based, right? Google's revenue, you have a repayment on the other end, and same for Amazon, right? A lot of these businesses include a take rate. So that's not how much transactions they enable. So keep that in mind. So the control of the US economy of these companies, I could argue, is close to 20%. That's how crazy this gets. I mean, these companies are so overwhelming. We don't see very often these numbers in revenues. I'm very impressed whenever I analyze these companies. And I think index funds such as the Nasdaq, which these companies represent about 50% of the Nasdaq, that gives me great confidence in the future of even stock market in general, but at least high growth stock market in general. If I look at Amazon, 3 times sales, revenue growth is still excellent. I mean, look at how excellent. 12% revenue growth for Amazon. It's still very good. For companies of this size, it's all excellent aside from Apple. And I'll get to Apple in a second. NVIDIA is out of this world, obviously. NVIDIA is absolutely out of this world. Tesla used to be just as of this world as NVIDIA, but right now a lot of people are buying cars, they're delaying purchases, and so analysts are discounting how much revenue growth Tesla will have down to 19%. But Tesla, if you remember, used to be 50%. Tesla used to grow as fast as NVIDIA, and my guess is that by the time NVIDIA gets to a slowdown and something that looks more like a Tesla will be back into hyper growth with the Model 2. It's kind of my guess. That's why I think it's a good time to accumulate Tesla. That's what I'm doing right now. Going back to Amazon gross margin is good for e-commerce, right? It's an e-commerce website. You're selling stuff here. And the EBITDA margin is fairly low at 15%. Now, keep in mind, Amazon is a stock that can turn on profitability at any time. They are still trying to take all of the market share and to be the absolute leader. This is a company, Amazon, which one day will turn on its profitability. And it's worth mentioning that I do own Amazon in a savings account type position for me, and I do own Google too in a savings account type position. I don't cover these much on the channel because they're not hyper growth, right? I mean, it's double digit, but lower double digits, so still not hyper growth. Now, Google has had a lot of backlash lately. The situation for Google, to me right now, it looks very much like the situation of Meta 2 years back, and I think Google needs a new CEO and somebody who actually, quote unquote, cuts the fat, and make the company lean and mean again, and not be this administration. Google oftentimes is looking more like an administration than a quote unquote lean and mean company, and so because of that, I wish they had a new CEO or something like that. I don't know what's going to happen with Google, but they keep making mistakes in their AI and in releasing their AI and in being late, and when they're not late, very inaccurate. I used to be much more positive about Google when it was Gemini, right? Back 10 months back, but it's true that there's been a negative sentiment on the stock, and it's too bad because the properties of Google are outstanding. Google owns YouTube, where we are on right now. I mean, YouTube standalone, in my view, it could be valued at $1 trillion. Standalone. This is a deeply undervalued company. If you ask me, I mean, they have a huge cloud division, just like Amazon. They have Gmail, which is totally not monetized. They have 5% of SpaceX. That should be reflected in the stock price, but they own 5% of SpaceX. This is nowhere to be seen. They have Android, right? They're in direct competition with Apple on the software side with their Android business. I mean, Google is a stock I don't want to sell. I just wish we had a CEO who was more targeting, towards profit. 10% revenue growth is still excellent, and that is because we are seeing a slowdown, by the way, in advertising. But advertising will recover at some point. Gross margin is excellent at 57%, 33% when it comes to EBITDA margin. So you get to a rule of 40, of 43, so above the rule of 40, and it doesn't look that cheap though when you use enterprise value over gross profit over revenue growth. And of course, that is because my spreadsheet penalizes companies with low growth. In the way I look at stock, 10% is not considered too high But again, look at the base, $307 billion, right? So look at that base, right? Moving on to Microsoft. Microsoft is an expensive company. I mean, trading at 13 times revenue. It's the only $3 trillion company. There used to be two of them. Now it's just Microsoft. Microsoft, I think, has been maybe a victim, or maybe it's warranted. I don't know. But the AI, people are getting heavily excited about the AI, and the question is how much of outsized profit is going to flow to Microsoft, how much of the outsized profit is going to flow to NVIDIA. When I look at this, it seems clear that the market is telling us that all of the outsized profits of AI are going to flow to NVIDIA, but the market is hopeful about Microsoft. Microsoft is expensive on my spreadsheet at a 1.6, and that's because the revenue growth estimates are not that great. And when you look at a company that's $227 billion in software sales, you need to really sell a lot of AI to move the needle, right? It's not that easy to move the needle. Nonetheless, it's a money printing machine at 52% EBITDA margin, second only to NVIDIA, which is why the rule of 40 gets us to a 64%, which is outstanding. Now moving on to Apple. And Apple, of course, the problem with Apple is how expensive the company is. It shows as very expensive on my spreadsheet because it's only growing at 2% revenue growth, and therefore my spreadsheet heavily penalizes that. And thus, I get a 7.5 on the enterprise value over revenue growth, gross profit over revenue growth. So that's very high, and we don't break the rule of 40, even though 34% is a great margin for hardware business, absolutely outstanding. But we don't break rule of 40 because they're only predicted to grow at 2%. And again, is this a short-term thing? For Apple, are people gonna renew to the next iPhone? Or are people just using an old iPhone? Well, it could be something as simple as them adding a new feature, a new must-have feature in the iPhone. A lot of people are talking about them revamping Siri and making Siri, talk like a Chat GPT. And if Siri was revamped and talked like a Chat GPT, then it would push a whole bunch of people to update to the latest iPhone, creating a new cycle. I myself have been very positive about Apple when it comes to the Apple Vision Pro. I actually tried it, made a video about that a few weeks back, and I think the Apple Vision Pro is a visionary product, pun intended, I suppose. It's a visionary product. It's really stunning. I find Vision Pro superior to Meta, contrary to what Zuckerberg says. But you'd have to try it, you'd have to experience it to really think for yourself and see for yourself. The problem is that even if Apple Vision Pro is that great, in my view it is, you need to sell a whole lot of them to move the needle. I mean, we are nearing $400 billion in revenue. You need to sell a lot of stuff to move the needle, and that's going to go through iPhone and next-gen iPhones, which they need to release and make attractive enough so that people switch. Like removing the phone charger and saying that it's more environmentally friendly is not enough to push people to switch, right? You need to do more than just remove the phone charger, right? I mean, anyways, and maybe you should have kept it. Maybe, I don't know. Let me finish with Meta. Meta is another one of these stocks that I used to own and that I sold too quickly. I regret selling it as well. Meta is compelling when I look at this. I mean, okay, it's a little high on EV over revenue, but keep in mind it's a software. It's a social media, but it's an advertising business on top of a digital layer, right? There's no hardware. I mean, there is MetaQuest, but it's mostly no hardware in how they make revenue, and because of that, they can grow faster. They're predicted to grow at 15%, which is actually the third best of all the Magnificent Seven. Gross margin is just outstanding at 81%. And look at this. If you look at this, this is very telling. They have 81% gross margin, 46% EBITDA margin. That's mostly advertising for Meta, right? You know another company that's mostly advertising? Google. Google's money is mostly made for advertising too, but they have 57% gross margin and only 34% EBITDA margin. What is Google doing? I mean, Google needs to trim some fat. They need to do something about their structure, their reporting system. I don't know what they need to do that Meta did to increase these numbers, but Google can do that. Google can be a stock that resets just like a Meta, in my view, and becomes much more profitable. So, anyways, they're not there yet, but when I look at Meta, it's cheap on EV over GP over RG. It's a 0.73, and it's a rule of 60 as well on my rule of 40. So objectively, even though, and that's why I say the cheapest. When I look at this, when I look at my favorite metric, the cheapest are objectively Amazon and Meta. They are the cheapest, but Meta is objectively. Perhaps, I mean, it all depends what you think, but as far as the numbers go, it is perhaps better than Amazon because of that margin. Now, of course, keep in mind, like these are all financial numbers, right? They don't tell us anything about more qualitative things, like the strategy, like the competition, like, you know, what are the new products, the pipeline, the customer acquisition cost, the lifetime value of a customer, their moat. I mean, in the case of Meta, right, moat is a clear advantage for them because it's a network effect, right? Network effects are still an area where moats still make sense. You know, we can't look at numbers and have that into account, right? Or like if you look at NVIDIA, yeah, NVIDIA looks absolutely appealing in the numbers if you look at this, but you know, there's always the issue of where they have these products made, right? At TSMC, and what happens if there's an issue with TSMC, right? They have mostly one maker of products. So, anyways, these numbers don't tell the full story. You have to look at the qualitative analysis first. And when I do qualitative analysis first, there is one company that comes back over and over and over again, and that would be Tesla. That's what comes back for me. NVIDIA is very compelling too. But the question for NVIDIA is you know, the semiconductor industry has historically always been very cyclical. And the question is, are we going to have a drop in sales in 25 or in 26? And when that happens, does that mean the valuation is going to take a dive until we go to the next wave of upgrades? So that's typically how a stock like NVIDIA has grown. So, you know, but keep in mind, I'm biased here because I really want to own NVIDIA, but not at these prices. So, you know, and that's a lot of psychology too. That's a lot of psychology too, because I remember my former cost basis. So it's a lot of psychology. Maybe it's silly. It's probably silly, and you shouldn't think like that. But, you know, that's sometimes that's just the way it goes. So this was not investment advice, no financial advice. This is just entertainment. Hoping you were entertained. Please like, please subscribe. Thanks for watching, and have a wonderful day.